There is a single fundamental mindset shift that separates the consistent winners from the legions of hopefuls who are destined to lose. The path to a millionaire's fortune in the market is not paved with secret formulas, complex indicators, or hot tips whispered in confidence. It is built upon the bedrock of one profound realization, a truth that Jesse Livermore spent years and millions of dollars to master. The transformation of one's approach from that of a gambler to that of a businessman. The amateur, the gambler, sees the market as a casino, a place of thrilling bets and the promise of unearned riches. The professional, the millionaire, sees it as an enterprise. He understands that, like any other business, speculation demands serious study, strategic planning, capital management, and above all, an unwavering discipline to execute that plan. This is the one mindset you must adopt. It is the beginning of trading like a millionaire. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The vast majority of people who enter the speculative markets are doomed to failure before they make their first trade. The reason for this is not a lack of intelligence or a shortage of capital, but the adoption of a fundamentally flawed mindset. They approach the market as a gambler, and the gambler's mindset is a cocktail of three lethal poisons: the lust for quick money, the reliance on unsubstantiated information, and the incessant craving for action. This mindset is not an occasional error. It is a chronic condition. As Livermore himself concluded, the game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, nor for the get-rich-quick adventurer. They will die poor. The get-rich-quick adventurer is the most common archetype. He comes to the market not to build a fortune over time, but to seize one overnight. He's not interested in a 25% annual return that a successful merchant might celebrate. He's looking for 100% in a week or even a day. This desire for instant gratification makes him incredibly vulnerable. He has no patience for the market to set up, no time for a well-reasoned plan to unfold. He needs a profit now. This urgency forces him to take extraordinary risks, to trade on thin margins, and to jump at any sign of movement, regardless of its validity. He is perpetually chasing the market, always one step behind, and his account is inevitably chipped away by a series of impulsive, ill-timed bets. This gambler's mindset is fueled by a desperate reliance on tips and rumors. How people want tips, Livermore observed. They crave not only to get them, but to give them. The gambler abdicates the responsibility of his own thinking. He does not wish to do the hard work of studying conditions or keeping records. He wants to be told precisely what to do. He will listen to anyone, a broker, a friend, an anonymous insider quoted in a news slip, who offers the promise of easy money. This makes him the perfect victim for manipulation and misinformation. He willingly accepts bullish statements at the top of a market and panicked rumors at the bottom, because these stories feed his emotional state of greed or fear. He never asks the critical questions, never demands evidence, because the tip itself is the end of his intellectual journey, not the beginning. He is betting not on market facts, but on the word of another, a practice that consistently leads to ruin. The most destructive trait of the gambler, however, is the constant need for action. He cannot stand to be out of the market. A flat account to him feels like a missed opportunity. There is the plain fool, Livermore noted, who does the wrong thing at all times everywhere, but there is the Wall Street fool who thinks he must trade all the time. This incessant trading, this hankering for activity, is the enemy of sound judgment. It forces the speculator to make commitments when no clear opportunity exists, to trade in choppy, get-nowhere markets, where the only certainty is the steady accumulation of commissions and small, debilitating losses. Livermore himself, even after years of experience, confessed to this weakness. He recounted a time when he had correctly analyzed the cotton market, and was certain a great rise was coming. But the market was not yet ready. It was dull and inactive. His impatience, his gambler's desire to be in the game, got the better of him. He entered the market prematurely, was shaken out by its lifelessness for a small loss, and repeated this error 5 times. "I permitted impatience to outmaneuver good judgment," he admitted. By the time the real, powerful move began, his capital was diminished and his spirit was broken. He had missed the $1 million opportunity because he could not resist the gambler's urge to play every hand. The solution to this self-destructive cycle is a profound and total shift in perspective. It is the conscious decision to abandon the gambler's mindset and adopt that of a serious businessman. Livermore was emphatic on this point. Anyone who is inclined to speculate should look at speculation as a business and treat it as such, and not regard it as a pure gamble as so many people are apt to do. This is the single mindset shift that changes everything. It is the foundation upon which a millionaire's fortune is built. What does it mean to treat speculation as a business? It means, first and foremost, that it requires work and study. The businessman does not guess about his inventory or his market. He gathers facts and analyzes data. The speculator as businessman must do the same. Livermore spent 40 years devoted to making speculation a successful business venture, constantly discovering new rules and testing new ideas against his records. He did not rely on hunches or impulses. He based his commitments on a definite basis for that anticipation. He studied economic conditions, analyzed the behavior of price movements, and sought to understand the psychology of the public. This was not a hobby, it was his life's work. Second, the businessman understands the critical importance of record keeping. A merchant knows his costs, his sales, his profit margins. A speculator must know his own performance with the same clinical precision. Livermore was a fanatic about keeping his own records. He did not trust charts, which he found confusing, but he meticulously recorded price movements himself. He understood that the very act of keeping your own records, of putting down your own figures, forces you to engage with the market on a deeper level. You will be surprised how many new ideas you will formulate in so doing, ideas which no one else could give to you, he wrote. His records were not just a history of prices, they were his map for anticipating future movements, his guide for identifying the critical pivotal points where major trends began. Third, and most importantly, the businessman is patient. He does not expect to build an empire in a day. He understands that real sustainable growth takes time. The gambler wants 100% in a month. A successful businessman, Livermore noted, would be pleased with a 25% return on his investment in the first year. This patience is the speculator's greatest asset. It allows him to wait for days, weeks, or even months for the perfect opportunity to present itself. It allows him to stay out of the choppy, unprofitable markets and preserve his capital and his mental clarity for the few times a year when a great, clear movement is underway. There are times when one should speculate, and just as surely there are times when one should not speculate, he insisted. The businessman speculator is not afraid of doing nothing. He understands that in those periods of inaction, the impatient gamblers are laying the foundation for his next successful venture. Adopting this business-like approach is the most crucial step a speculator can take. But how does one learn to think like this? Just as a student of business would study the careers and methods of the great industrialists, a student of the market must immerse himself in the minds of its greatest operators. The lessons of history, the memoirs of those who have navigated the treacherous waters of Wall Street and emerged with fortunes intact, are an invaluable education. To this end, a new channel, Wall Street Memoirs, has been created to serve as a library of this essential wisdom. This is not a channel for hot tips or fleeting market gossip. It is a repository of the timeless strategies, the hard-won philosophies, and the personal recollections of the legends who shaped the financial world. By studying their campaigns, their successes, and just as importantly, their failures, you begin to understand the business of speculation at its highest level. You learn how they managed capital, how they analyzed conditions, and how they cultivated the discipline to act like true professionals. For anyone committed to making this mindset shift, Wall Street Memoirs is an essential resource for learning how to both preserve and multiply your capital. The link is in the description. Adopting the mindset of a businessman is the foundational act of transformation for a speculator. But a mindset alone does not yield profits. It must be translated into a set of working principles, a mechanical approach that governs every action in the market. A successful business is not run on emotions, hopes, or guesses. It is run on facts, sound capital management, and strategic patience. Jesse Livermore, in his evolution from a gambler to a market professional, developed a methodology that embodied these business principles with profound clarity. This was the machinery that powered his greatest campaigns, the mechanics of the Millionaire Mindset. The first and most fundamental principle of this business approach is that all decisions must be based on facts, not on hope or opinion. For a businessman, facts are found in inventory levels, sales reports, and market conditions. For Jesse Livermore, there was only one source of undeniable fact: the market itself. His most famous aphorism, "Markets are never wrong, opinions often are," was not a clever turn of phrase. It was the cornerstone of his entire operational philosophy. He understood that his own opinion, no matter how brilliantly conceived or deeply researched, was worthless until it was validated by the action of the market itself. The speculator's job is not to argue with the tape or to impose his will upon it, but to decipher its message and act accordingly. The tape is the ultimate arbiter of truth. How then did Livermore extract these facts from the market? He developed a systematic method for demanding confirmation before making a significant commitment. He learned through costly experience that acting on an opinion prematurely was the most certain path to loss. He wrote, "After forming a definite opinion with respect to a certain stock or stocks, do not be too anxious to get into it. Wait and watch the action of that stock or stocks market-wise." This waiting was not passive. It was an active search for a specific confirmatory signal. That signal was the crossing of what he termed a pivotal point. A pivotal point was a price level of strategic importance, a new high for a movement, a major round number, or the breach of a long-term consolidation range. The crossing of this point was the market's own declaration that the period of indecision was over, and that the line of least resistance had been clearly established in one direction. It was the factual evidence he required before he would risk his capital. It transformed his entry from a speculative guess into a business decision based on verified market strength. Even with the signal of a pivotal point, his demand for facts was not yet satisfied. He never plunged into a full position at once. His first move was always a small, exploratory bet, a probe designed to test the market's immediate response. This initial trade was a question asked of the market. Is my timing correct right now? The market's answer came immediately in the form of a small profit or a small loss. If the initial trade showed a profit, it was a factual confirmation that he was in harmony with the market's immediate momentum. If it showed a loss, it was a factual refutation of his timing. This initial test was a critical part of his fact-finding process. It provided an immediate real money verdict on his judgment, allowing him to proceed with confidence or retreat with minimal damage. The second principle of the business approach is the management of capital as a precious business asset. A successful businessman does not throw good money after a failing product line. He protects his capital and allocates it to where it will be most productive. Livermore applied this same cold logic to his trading. This led to his most inflexible rule: never average losses. He saw this common practice as the ultimate violation of sound business principles. "That is a most common practice," he wrote with disdain. "Great numbers of people will buy a stock, and 2 or 3 days later, if they can buy it at a lower price, they are seized with the urge to average down." He viewed this as a form of financial insanity. To add to a position that is already showing a loss is to reinforce failure. It is a bet made not on evidence, but on pure, desperate hope. The businessman speculator must act like his own insurance broker, and the first premium he pays is taking the first small loss. Profits always take care of themselves, he famously stated, but losses never do. The speculator has to insure himself against considerable losses by taking the first small loss. The logical corollary to this rule is the core of his wealth-building strategy, the method of pyramiding. While averaging down is the act of reinforcing failure, pyramiding is the business strategy of reinforcing success. It is the practice of adding to a position that is already showing a profit. This is the ultimate expression of the business mindset, reinvesting in what is working. A businessman expands the department that is most profitable. He does not pour more resources into the one that is losing money. The speculator must do the same. Livermore's rule was to buy on a rising scale. He would make his initial exploratory purchase at the pivotal point. If it showed a profit, he would buy a second lot, but only at a higher price. If that too showed a profit, he would buy a third lot, again at a still higher price. Each succeeding purchase was a vote of confidence backed by the market's own evidence. This method ensures that the speculator has his largest position on only when he is most correct, and when the market is moving most strongly in his favor. It is a strategy of offensive capital allocation, designed not merely to preserve capital, but to aggressively compound it on the back of a proven correct judgment. The third, and perhaps most difficult principle of the business approach is the cultivation of patience as a primary virtue. A businessman understands that significant results are not achieved overnight. A great enterprise is built over time, through strategic planning and consistent execution. The gambler, in contrast, craves instant results. Livermore came to realize that this was the fundamental difference between his early, inconsistent trading and his later massive successes. He learned that the truly life-changing money was not made in the frantic day-to-day fluctuations, but in the great sustained trends, the big swings. He wrote, "The game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, nor for the get-rich-quick adventurer. The get-rich-quick mindset is the enemy of patience." This realization led him to develop his famous principle of sitting tight. He concluded, "It never was my thinking that made the big money for me. It always was my sitting." This is one of the most profound and misunderstood statements in the history of speculation. Sitting tight is not a passive act. It is the active, disciplined decision to hold a correct and profitable position, to resist the fearful impulse to snatch a small profit and to allow the trend to run its full course. The average man, having secured a small profit, is terrified of losing it and rushes to sell. The businessman speculator understands that his profit is the market's confirmation of his judgment, and it provides him with the courage to hold on for the much larger gain that the major trend promises. He has the patience to sit through the normal reactions, the healthy and expected pullbacks that shake out the weak and fearful. His business plan is not to scalp a few points, but to capture the heart of the great move, and this requires the unwavering patience to stay with it. Disregarding the big swing and trying to jump in and out was fatal to me, he confessed. The adoption of this one principle was the final key to unlocking the millionaire mindset. The struggle to implement these business principles in the emotionally charged arena of the stock market is the central drama of a speculator's life. It is a battle fought not against the market, but against one's own ingrained human weaknesses. There is no document that captures this internal conflict with more honesty and psychological insight than Edwin Lefebvre's classic Reminiscences of a Stock Operator. The book is far more than a biography or a collection of market anecdotes. It is a deep psychological case study of a man's lifelong battle to transform himself from a gambler into a professional businessman speculator. It takes you inside his mind as he makes and loses fortunes, allowing you to witness his thought process in real time. To truly master the lessons of Livermore, one must understand this psychological journey. The detailed chapter-by-chapter analysis of Reminiscences by Max Davidson acts as a modern-day business coach. It dissects each of Livermore's trades as a business case study, revealing where his adherence to business principles led to millions in profit, and where his surrender to emotion led to financial bankruptcy. It is an indispensable guide for anyone who wishes to not just learn the rules, but to internalize the mindset that made them work. The link is in the description. The adoption of a business-like methodology, complete with rules for entry, capital management, and strategic patience, provides the necessary structure for successful speculation. However, this structure alone is an empty vessel. It is the speculator's mind, his emotional discipline, that must fill it. The final and most profound transformation required to trade like a millionaire is the construction of a psychological fortress. This is the inner citadel where the trader learns to conquer the most powerful and insidious enemies he will ever face: his own hope and his own fear. Jesse Livermore's journey to mastery was not a technical one, but a psychological one. He learned that the mechanics of trading were secondary to the mastery of self, and that the business mindset was, above all, a system for emotional control. The first step in building this fortress is to recognize the true nature of these internal enemies. In the business of speculation, hope and fear are not allies. They are saboteurs, and they achieve their destructive work through a cunning inversion of their natural roles. The average man, the gambler, hopes when he should fear and fears when he should hope. When a trade goes against him, showing a loss, he is consumed by hope. He hopes for a recovery, for a second chance, for the market to vindicate his initial judgment. He clings to a failing position, unwilling to accept the reality of his mistake. The business mindset offers a cold, logical antidote to this emotional poison. A businessman does not hope that a failing product line will suddenly become profitable. He analyzes the facts, acknowledges the failure, and liquidates the inventory to cut his losses and free up capital for a more promising venture. Livermore learned to apply this same dispassionate logic to his trading. A losing stock position is a failing product line. To hold on to it is to violate every principle of sound business. He trained himself to reverse the natural emotional response. When a trade showed him a loss, he did not feel hope. He felt an immediate and acute sense of fear. He feared that the small, manageable loss could grow into a devastating one. This fear was not a paralyzing emotion, but a catalyst for immediate, decisive action. It was the signal to close the position, to amputate the gangrenous limb before it could poison the entire portfolio. Profits always take care of themselves, he famously stated, but losses never do. The speculator has to insure himself against considerable losses by taking the first small loss. The business mindset transforms fear from an enemy into an essential risk management tool. Conversely, when a trade goes in his favor and shows a profit, the amateur is filled with fear. He is terrified that his fragile paper profit will be snatched away by the market's next fluctuation. This fear compels him to sell too soon, to take a small, quick gain and abandon a position that could have become the foundation of a great fortune. The businessman speculator once again reverses this impulse. A profit is a factual confirmation from the market that his judgment is correct. It is the equivalent of a product line that is flying off the shelves. This is not the time for fear. It is the time for hope and courage. It is the time to have the conviction to hold the position, to sit tight, and to allow the winning trade to run its full course. This psychological reversal is the very essence of the millionaire mindset. It is the discipline to be ruthless with failure and patient with success. The second pillar of the businessman's psychological fortress is the cultivation of a long-term vision. The gambler is fixated on the present, on the next tick of the tape, on the immediate possibility of a small profit. The businessman, by contrast, is always looking ahead. He analyzes broad trends, studies underlying conditions, and makes his decisions based not on today's news, but on the anticipated probabilities of the future. Livermore's own career was a perfect illustration of this evolution. He began as a pure tape reader, a master of the market's immediate fluctuations. But his greatest successes came only after he learned to lift his gaze from the tape and study the horizon. He became a student of general conditions, realizing that the big money must necessarily be in the big swing. He learned that the course of the market is always from 6 to 9 months ahead of actual business conditions. Today's strong earnings report is not a reason to buy a stock. It is merely a reflection of past success. The real question the businessman speculator asks is, what will the earnings look like 6 months from now? This forward-looking perspective is what allows a speculator to position himself for the great movements before they become obvious to the general public. His legendary campaign during the 1907 panic was the ultimate demonstration of this principle. He was not reacting to the panic. He had anticipated it for months by analyzing the tightening money supply and the unsustainable credit situation. He had positioned himself not based on the market's current mood, but on the inevitable consequences of the underlying economic facts. This ability to work on a forward-looking plan, to act on probabilities rather than reacting to news, is a core component of the business mindset. This necessity for a broad structural understanding of the market is where the methodology of Richard Wyckoff provides an indispensable set of tools. If the business mindset demands a long-term vision, Wyckoff's work is the telescope that brings that vision into focus. He taught that the market moves in cycles, driven by the campaigns of large, informed operators. His concepts of accumulation and distribution are, in effect, a way to read the macroeconomic report of the market itself. Learning to identify a Wyckoffian accumulation phase is like a businessman recognizing a new emerging market demand before his competitors. It provides the strategic confidence to take a large position and to sit tight through the entire subsequent markup phase, which is the great bull trend. Understanding Wyckoff's logic gives a speculator the structural framework to make sense of the general conditions that Livermore spoke of. It elevates his analysis from an intuitive feel to a repeatable logical process. For any speculator who wishes to adopt this professional forward-looking vision, the Richard Wyckoff Trading Methods channel serves as a crucial educational resource for mastering this essential skill. The final transformation, the culmination of this entire process, is the full and complete adoption of the mindset of a business owner. This is the one mindset that will allow you to trade like a millionaire. The speculator who embodies this mindset takes full and absolute responsibility for his decisions. He does not blame bear raids or market manipulation for his losses. He recognizes them as the result of his own errors in judgment or timing. He does not see these errors as failures, but as tuition fees for his education. He studies his mistakes, learns from them, and ensures he does not repeat them. His decisions are based on the cold, hard logic of facts and probabilities, not on the treacherous emotions of hope and fear. He operates with a clear, written plan, and he possesses the unwavering discipline to follow it. He understands that speculation is not a path to easy money, but a serious enterprise that rewards diligence, patience, and intellectual honesty. In the pursuit of profits from the speculative markets, the most prevalent and consistently fatal error is that of premature commitment. The average individual, driven by an inherent desire to secure the best possible price, equates earliness with advantage. He sees a stock that has declined and perceives it as cheap. He witnesses the first flicker of a rally and mistakes it for the dawn of a new bull market. He acts on hope, on opinion, on the fear of missing out on the very beginning of a move. This instinct, while understandable from a common sense perspective, is the very antithesis of sound speculative practice. The history of the market is a testament to the fact that the initial moves, the first signs of a supposed reversal, are more often than not deceptive. They are false starts, designed by the market's own mechanics to punish the impatient and to shake out the weak before the true trend reveals itself. Jesse Livermore, through a series of costly and painful lessons that cost him fortunes, learned this principle with absolute finality. He discovered that the most critical skill for a speculator is not the ability to forecast, but the discipline to wait for the market itself to provide confirmation. The trap of early buying is ever present, and understanding why the first moves are usually fake is the first great step toward moving from the gambler class to that of the intelligent speculator. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The greatest single enemy of a speculator is not external market forces, but the internal compulsion of impatience. The desire to be constantly engaged in the market, to have an interest at all times, is a weakness that will eventually lead to ruin. Livermore himself was not immune to this flaw, and the most illustrative and costly lesson of his career was a direct result of it. He had conducted a thorough analysis of the cotton market and had formed a definite and, as it turned out, entirely correct opinion that it was due for a substantial and prolonged rise. His logic was sound, his study exhaustive. He possessed the correct market thesis. However, the market itself was not yet ready to align with his view. It was in a state of lethargy, trading in a dull, narrow range, showing no signs of the imminent advance he foresaw. It was here that his impatience betrayed his judgment. He could not tolerate the wait. He felt the need to act on his opinion immediately. He entered the market, making an initial purchase of 20,000 bales. In a thin, inactive market, such a large order created its own artificial momentum. The price rose slightly on his buying. But the moment his buying was complete, the upward pressure vanished, and the market settled back into its previous state of inactivity. The move was a fiction of his own making. Frustrated by the market's refusal to perform, he grew tired and sold out his position, accepting a significant loss. A few days passed, but his conviction in his analysis remained unshaken. He re-entered the market, buying back his 20,000 bales. The result was an exact repetition of the first attempt, a brief buying-induced flicker of strength, followed by an immediate return to the doldrums. Once more he sold out, compounding his initial loss. This cycle of premature action and frustrated liquidation was repeated 5 times over 6 weeks. Each attempt was a testament to the correctness of his long-term view, but a failure in its immediate timing. In total, he lost nearly $200,000 trying to force a move that the market was not prepared to make. His disgust with his own lack of discipline became so great that he ordered the cotton ticker removed from his office, unable to bear the temptation it presented. The painful irony of this episode was sealed just 2 days later. With his capital diminished and his patience finally exhausted, the true market move began. Cotton started a powerful, sustained advance of 500 points, one of the greatest of the era. He had been entirely right in his analysis, but his inability to wait for the market's confirmation had cost him not only the $200,000 in losses, but also the $1 million profit that his correct position would have yielded. This experience was the genesis of one of his most fundamental rules. A speculator must not act on his opinion alone, but must wait for the market itself to confirm that opinion. The early moves he had tried to initiate were fake because they lacked the one essential ingredient for a sustainable trend: broad, organic buying power. His own buying was the only support, and when it was withdrawn, the price structure collapsed. This phenomenon is not an anomaly. It is the very nature of a market that is preparing for a major move. During these periods, which Livermore described as a narrow market, when prices are not getting anywhere to speak of but move within a narrow range, the forces of supply and demand are in a state of equilibrium. There is no clear directional pressure. The small, erratic fluctuations within this range are not the beginning of a trend. They are the signs of a market in consolidation. To act on these minor movements is to gamble on noise, not to speculate on a signal. It is an attempt to anticipate the move. and anticipation, Livermore learned, is the most certain path to financial loss in speculation. The intricate mechanics of these preparatory market phases were studied and systematized by one of Livermore's great contemporaries, Richard Wyckoff. While Livermore developed an intuitive feel for these periods of market inaction through his intense observation of the tape, Wyckoff provided a logical framework and a precise anatomy for them. He termed these phases accumulation and distribution. An accumulation phase is a period during which large, informed operators, whom Wyckoff referred to as the composite man, are quietly absorbing shares from the uninformed public. This is done with great skill, often involving the creation of deliberately confusing and misleading price action. There may be minor rallies designed to encourage selling from those who are happy to get out with a small profit, and sharp shakeouts designed to frighten weak holders into relinquishing their shares. These are precisely the fake moves that trap the early buyer. Conversely, a distribution phase at a market top involves the composite man selling his large holdings to an eager and optimistic public, a process also masked by volatile and deceptive price action. Wyckoff's methodology offers a detailed, logical way to analyze these phases by studying the relationship between price and volume, allowing a trader to understand the underlying campaign of the large operators. It provides a structured science to complement Livermore's intuitive art. For any student of the market who wishes to progress beyond simple price watching and learn to diagnose the market's true condition, the channel Richard Wyckoff Trading Methods is an invaluable resource. It offers a systematic education in identifying these critical market phases and avoiding the traps they set for the untrained eye. A link is available in the description. Having learned the immense cost of impatience, Livermore's entire approach was re-engineered around the principle of waiting for irrefutable confirmation from the market. This became the foundation of his business of speculation. He was no longer a gambler trying to guess the next move. He was a strategist waiting for the opponent to declare his intentions before committing his forces. His primary tool for this was the pivotal point. This was not some esoteric calculation, but a specific, historically significant price level that, once breached, signaled a fundamental shift in the balance of supply and demand. Whenever I have had the patience to wait for the market to arrive at what I call a pivotal point before I started to trade, I have always made money in my operations, he stated. This was the moment the line of least resistance, previously ambiguous, became clear and decisive. He provided a concrete illustration of this principle. Consider a stock that has been trading for a considerable period within a range, for example, between $22 and $28. A speculator may form a very strong opinion that the stock is fundamentally undervalued and should eventually sell at $50. The amateur, acting on this opinion, would buy the stock at any point within that range, perhaps at $25. He would then be forced to endure a potentially long and frustrating wait, his capital tied up in a dormant position. He might grow tired and sell out just before the real move begins. The professional, Livermore explained, would have patience and wait until the stock becomes active, until it makes a new high, say around $30. The breach of this $30 pivotal point is the market's own signal. You will then know that market-wise you have been justified, he wrote. The stock must have gone into a very strong position, or it would not have reached $30. The move is on. That is the time for you to back your opinion. The early buying within the range is a bet on an opinion. The buying after the pivotal point is crossed is an investment based on market-confirmed evidence. The classic demonstration of this principle was his trade in Bethlehem Steel in 1915. After a period of being broke and in debt, he had secured a small credit line of just 500 shares. His first trade had to be successful. He could not afford a mistake. He was profoundly bullish on Bethlehem Steel and believed it was destined for a major advance. The stock was climbing steadily. At 80, the temptation to buy was immense. At 90, it was agonizing. Every point the stock rose without him was a reminder of the profits he was forgoing. Yet he held himself in leash. He waited. His pivotal point was the psychologically significant level of $100. For 6 long weeks, he did nothing but watch and wait, a period he described as the most strenuous of his life. Finally, as the stock approached par, his tape reading confirmed the immense buying power beneath it. He did not even wait for it to cross 100, but began accumulating his line between 99 and 99 3/4. The confirmation was immediate and explosive. The stock never looked back, closing at 115 that same day and reaching 155 within a week. The enormous profit was his reward, not for being bullish, but for having the discipline to wait for the exact psychological moment to act on that bullishness. Even with the signal of a pivotal point, Livermore's method required a final layer of confirmation. He never committed his full line of stock at a single price. He viewed this as a wrong and dangerous practice. Instead, he employed a method of market testing through pyramiding. His first entry was always a probe, an exploratory commitment representing only a fraction of his intended total position. He would, for example, start by buying 100 shares out of a planned 500. The market's reaction to this initial trade was the final and most important signal. If your first trade shows you a loss, he warned, why should you go to work and get more stock? He ought to see at once that he is in wrong, at least temporarily. A loss on the initial probe was an immediate signal that his timing was incorrect. The line of least resistance was not yet clear or was moving against him. The only correct response was to close the trade immediately and accept the small loss. If, however, the initial trade showed a profit, it was the market's way of saying, you are right, proceed. It was a confirmation that he was in sync with the market's immediate momentum. Only then would he make his second commitment. And the most critical rule of this process was that each succeeding purchase must be at a higher price than the previous one. This is the principle of buying on a scale up. It is the very opposite of the amateur's disastrous habit of averaging down. By adding to his position only as the price moved in his favor, he was ensuring that his largest exposure to the market occurred only when he was being proven right, step by step. His own trades had to confirm his thesis. The fact that your trades do show you a profit is proof you are right, he explained. This method is the ultimate defense against the fake move. If the initial rally is false and the price begins to recede, the speculator is stopped out with only a small loss on his initial small position. He has successfully avoided the trap. If the move is genuine, he is drawn into the market, his position growing in size as the trend itself gathers strength. The psychological toll of this disciplined waiting cannot be underestimated. To watch a stock you are bullish on advance day after day without you requires a level of self-control that few possess. The fear of being left behind is immense. Yet, Livermore understood that the psychological cost of premature entry is far greater. The speculator who buys too soon finds himself in a position that does not move. His capital is frozen, his mind filled with doubt. He becomes tired of waiting, his patience worn thin by the lack of progress. The chances are, if you had, he wrote, referring to buying too early, you would have become tired of waiting and would have been out of it when the move started. Because having once gotten out at a lower price, you would have become disgruntled and would not have gone back in when you should have. This is the tragic fate of the impatient speculator. He endures all the anxiety of the wait, only to abandon his post just before the battle is won. The professional, by contrast, endures the anxiety of waiting for the signal, but once he acts, he is rewarded with immediate confirmation and a profitable position that provides the psychological fortitude to see the great move through to its conclusion. In the final analysis, the ability to discern a false start from a genuine trend is not a matter of clairvoyance or luck. It is a science of discipline. It is the understanding that one's own opinion, no matter how well reasoned, is worthless until the market itself validates it. The first moves are so often fake because they occur during a period of market equilibrium, before a true imbalance of supply and demand has been established. To act during this period is to gamble, to wait for the breakout, for the confirmation of the pivotal point, and to test the waters before plunging in. That is the business of a professional speculator. This entire intellectual and psychological journey, from falling into the trap of early buying to mastering the art of patient confirmation, is the very soul of the speculator's craft. There is no document that captures this struggle more vividly or with more profound insight than Edwin Lefebvre's classic Reminiscences of a Stock Operator. The book is not a trading manual full of simple rules. It is a psychological autopsy of a master, chronicling his evolution through his most painful mistakes and his most brilliant triumphs. To read it is to gain a glimpse into the mind of a genius. But to truly internalize its lessons and apply them in the modern era, the detailed chapter-by-chapter analysis by Max Davidson is an indispensable guide. It acts as a modern-day interpreter, translating the century-old market language and psychological battles into a clear, actionable framework for today's trader. It is the closest one can come to a personal mentorship with Livermore himself, a chance to learn not just what he did, but how he thought. If you are serious about escaping the traps the market sets for the amateur and beginning to trade like a professional, the link in the description is your next step.